Happy Wednesday afternoon, everyone. Thank you so much for joining us today for another Barometer Wednesday afternoon webcast. I'm Pamela Hastings, and joining me today is David Burrows, Chief Investment Officer and President at Barometer Capital. David, thank you so much for taking the time. We look forward to a great session, especially as we have just come on the other side of the presidential election, but we do not have a named president yet. Look forward to getting your thoughts on that and your market update.
Great. Well, thanks very much, Pam. I'm not sure that my video is working today, but we'll do our best here. I guess we came into last week talking about the fact that some of our short-term indicators were giving us some cause for thought that we were headed into a week of sort of maximum uncertainty, which is what investors hate the most, and that it was likely we would see some bumpiness over the course of the week. I think that all of us suffer a little bit from PTSD from the last 4 years. There have been so many surprises along the way that we've all had to deal with. I think everybody was sort of ready for anything. Markets, I think, spent the last week sort of degrossing. Investors reduced their position sizes, put themselves in positions more of flexibility to deal with whatever was going to come. But I'd make a couple of notes. And the first thing is that in general, market has been fairly resilient. We've been through the toughest month of the year. And in fact, market handled it pretty well. As of last week, was down kind of 8% off the highs, which is fairly mild for October, especially given the fact that we're going into so much uncertainty, both with COVID and the election. But the backdrop is a fairly good one. We feel like we have been in a sort of a structural bull market that has been going on for some time, certainly with interruptions. But if you look at the channel of the S&P, really since it came out of the 2000 through 2013 bear market, we've been in a fairly consistent channel with obviously some big interruptions. This was February, March of this past year. So right sort of in the middle of the channel. If you look at the NASDAQ, NASDAQ has been at the sort of high end of the channel, and certainly has had interruptions along the way, but in general has been doing quite well. We talked about the fact that when you get through the third quarter, and there has been a strong quarterly gain, historically, fourth quarter sets up pretty well. And looking at the election and all of the things that we might have to deal with, I think people were sort of questioning that a little bit. But the reality is we come into a seasonally pretty strong period, and especially when the third quarter has been strong. So we expected some bumpiness. Things that investors might not like very much. We have been through some earnings that have been pretty strong, and certainly the beating expectations both on revenue and on earnings. Now, when we look at the S&P where we were last week, we talked about the fact that we were in this sort of little wedge pattern, and that we would resolve one way or the other, and that we had to be ready for both. We talked about the fact that we had a little bit of cash in the portfolio, 15 or 20%. And we wanted to make sure that we came into this week sort of in a flexible position. So as it stands, we came out to the upside, and very good, strong day today. Not all groups participating, but certainly the leading groups participating. And I think that that's a positive. Now, we think about it, it does appear like there's still lots of uncertainty. We don't have a president yet, or the US doesn't have a president yet. But there are some things that we know. The first thing is that likely the Republicans have control of the Senate. We know that markets in general like more gridlocked markets. There is less likelihood of really significant outlier changes when you have checks and balances. And so certainly it's going to be an interesting thing whether Biden wins or Trump wins. If Biden wins, Senate will act as a check and balance against making major changes. So the first thing that the market took away from that was highly unlikely that we're going to get really significant tax increases over the next couple of years, which I think was the biggest concern for the market, for the economy, around Biden potentially being elected. Now, it does look right now like there's sort of a 75 or 80% chance that Biden will ultimately wind up being the president. So there's pluses and minuses that come with that. One of the things that we think is less likely now is there's less likely a chance of major breakups of tech companies with sort of a split government. This was the NASDAQ 100 coming into this week, and where we were a week ago. Certainly it had been correcting for a couple of weeks. Here's where we are today. Market has had a really nice lift, and those leading tech stocks really regaining a bid and catching a lot of people kind of on the wrong foot. Now, as you know, what we care about is, are we seeing expanding breadth? Are more and more securities participating in a rally as we go along? Or are we seeing deteriorating breadth? And when we see deteriorating breadth, we want to be a little more cautious. We tend to have a little bit more cash. Last week, our global long-term breadth indicator had just reversed down based on some things that we had seen in the short-term indicators. But what we have seen since then was the percent of stocks trading above their 50-day moving average has started to rise. Certainly was up on Friday, was up on Monday, and then up sharply again. Will be up sharply again today. Percent of stocks trading above their 150-day moving average, which is the second short-term indicator we look at, reversed up as of yesterday. And the percent of stocks with positive weekly price momentum or upward trajectory also reversed up. So that is 3 of our 4 short-term indicators turning higher. So that is a positive. Last week, the short-term indicators were all weak. This week, after 3 days, we've seen short-term indicators reversing higher. And we thought last week that despite the fact that there was some sloppiness in our indicators, there were some things that made us cautiously more optimistic. We saw kind of an increase in the yield of a 10-year bond, which tends to happen when there's a little bit more appetite for risk, when people think that the growth rate in the future might be a little bit better. It may also have been rising because people were expecting Biden to spend a lot of money and have a lot of bond issuance. The copper-gold relationship moved more toward copper, which tends again to be an indicator of expectations for future economic growth. And the regional banks trading versus REITs, more economically sensitive versus not economically sensitive, had started to outperform over the last few weeks. So that's a positive. Now, so as we sit today, our short-term indicators are basically all positive, save percent of stocks making new highs versus new lows, which is close to reversing up. Also, the percent of stocks in uptrends in the S&P 500, which is a long-term indicator for the S&P, turned positive. Percent of stocks in uptrends in the NASDAQ 100, or those very heavily weighted tech stocks, turned higher. And the percent of stocks in uptrends in the S&P mid-cap 400 turned higher. So I would say that from last week to this week, we have seen a reduction in the amount of uncertainty. We are less open to very significant policy changes based on a potentially split government. And so far, this process seems to be quite orderly, despite the fact that we're going to have some contentious issues around some of the states. From a price perspective, the S&P 500 topped out in September, pulled back, rallied to a lower high in October, but pulled back, held the previous low, and is now rallying again. So from a point and figures charts perspective, the S&P 500 is on the upswing. Now let's look at the leading groups. This is an ETF that holds the highest momentum stocks in the US stock market. Now there's a little bit of subjectivity to this, but the net of it is that today, with a resurgence in US market, the sort of momentum areas of the market have regained the bid very quickly after correcting like the NASDAQ corrected. So that is a reemergence of the same leadership that had been leading into the pullback over the last couple of weeks. Let's go through some other groups. Semiconductors made, as of today, a new relative high and close to absolute high versus S&P and on an absolute price basis. Software, also very sharp up day today, reestablishing leadership. And of course, we have exposure here through companies like Microsoft, which has had just a dynamite record of growth over the last few years in their subscription-based and cloud-based services. And Twilio, which is a company that we own that provides sort of cloud-based services that enables software companies to provide sort of real-time feedback to their customers. Consumer discretionary is a group that, as you know, has been leading the market through the course of the year. Home Depot is a significant holding of ours. Again, very nice move higher today, back to relative highs versus the market. Costco, another one of our holdings. Again, nice, very nice, steady sort of long-term uptrend that the stock's in. So technology, both semiconductors and software, consumer discretionary, not just retail and online retail, which again today having a very strong day, but areas around home and home improvement. Home Depot, sort of a big winner there. So these are all structural themes that have been in place for some time, and it looks like they're fairly quick to reestablish. In industrials, robotics and automation is a theme that we've been focused on, and certainly having a nice lift. More basic industrials like Cummins Diesel. Now you'll see that some of the groups today, while tech has rallied, have pulled back off recent highs. It's an uneven rally today in the market, not all one way. Certainly, some of the strong groups over the last few weeks have pulled back a little bit, and I think that that's just more positioning than anything else. Transports, which have been quite strong, rallied over the last 5 days. Companies like CP Rail have been very strong, pulling back today, continues to look very constructive. And we talked also about a Cargojet as one of our favorite holdings. They have a 90% market share in air freight across Canada. Amazon owns a 10% stake. They have the right to take up to a 20% stake. They reported their earnings this week really strong and improving margins, better than what had been expected. In healthcare, biotech and genomics having a strong day today, reestablishing leadership, close to relative strength, new highs. Medical devices in the same camp. We have shares in IDEX Labs, which is labs and logistics equipment. Certainly a good space to be in currently. So these are all groups that have been under a structural benefit over the last few weeks. Other areas that give us thought that we likely continue to see improvement. Other risk assets like emerging markets, the emerging markets ETF. We talked about China and the very low cases and low deaths. The China 300 ETF having a very good move. Certainly the Chinese consumer, which has arguably been the strongest part of the global economy and certainly strongest part of the market, very strong. When we get to dividends and income has been a very difficult place to be over the course of the year. Dividend growth as we've talked about over the last few weeks, as having really good relative performance relative to the high dividend payers. So obviously with the COVID situation, there is a concern about the sustainability of dividends, and that is cross dividend payers. But high dividend payers are significantly underperforming the dividend growers, where we're focusing our attention, which is why our income strategy is having quite a good year relative to its peer group, which is having a very difficult year due to the difficulty in high dividend paying stocks. Groups that have been leading over the last few weeks have pulled back a little bit. The last few days, materials pulled back today, but they have been very strong on a relative basis. They hit new highs on Friday. The gold companies reported very strong earnings. Newmont last week really came in well ahead of estimate, pulled back a little bit today. Agnico Eagle is in the same camp. We have a fair bit of basic materials exposure, both to copper and to gold. And over the last 3 weeks, the banks have had a pretty good bid, pulling back today, but again, now trading above their long-term moving averages. And this is an important group to have as part of the rally. There are some groups that continue to underperform. Energy is a group that we continue to avoid below the declining long-term moving averages. Telecoms really fits into that high dividend camp. and does not benefit when rates work their way a little bit higher. So not a lot of change. We did, as we said, raise a little bit of cash last week. I suppose we would love to be fully invested today, but we're not. We have about 15% cash. Some portfolios a little bit more aggressively positioned than others, but the net of it is very small changes. We had taken down our exposure in technology a little bit as technology was pulling back, and built our positions in the industrials, which have been quite strong over the last month. Built our exposure in materials, which we've talked a little bit about companies like Freeport-McMoRan, and we bumped up our exposure to healthcare, which had pulled back a little bit. We're going to get a lot more news over the course of the week, and there is likely going to be legal challenges in various states. So I'm not saying that we think we are completely out of the woods in this bit of volatility, but we do think that seasonally we've made it turn. The indicators solidly have improved over the course of the last week. We have fewer unknowns in the market. There's still things we have to worry about. COVID is an issue, although it appears that in North America, we are less likely to go back into sort of full lockdown. Ontario looks like it's about to come out of lockdown again. US unlikely to go into lockdown. And it appears when we look at groups like financials and industrials and transports, that investors are looking beyond this COVID situation to what things might look like on the other side. So we don't know whether we're going to get fiscal stimulus or not. We do think that the Fed is standing in to backstop things. We are going to get more information over the course of the week. And I do expect to see the indicators that we use continue to become more favorable. And so I would expect that actually markets are pretty strong from here to the end of the year. But we'll certainly update as we go along. With that, Pam, if there's any questions, certainly happy to answer them. You know, as I talked about, we took a little bit of exposure down last week. We do that when things get bumpy to protect against major declines. And we'll just continue to adjust the sales as we move forward. But I think that in the portfolios, we are exposed to some really great structurally improving themes. And at the end of the day, if you go back and look at the history, who wins the presidency has very little to do with what happens in the stock market. It's one factor, and there's a whole bunch of other moving parts. And the sum of the total of the parts is improving as it stands right now, as opposed to deteriorating.
Thanks,
Pam, do we have any questions?
Yeah, we just actually have one question. I know you touched a bit on gold, but this investor is looking to find out if you remain bullish on gold and silver.
The very long-term picture for both for both gold and silver look really attractive, as does Bitcoin. And so if we think that there is going to be any kind of significant stimulus, that is supportive. And I see nothing that has changed the theme there. We pulled back to moving averages and in fact started to reaccelerate last week. If we go take a look at Newmont pulled back into the moving averages over the last 3 weeks and reversed up sharply off it. Agnico Eagle went through and did the exact same thing. Really sort of consolidated over the last few weeks. This is not a negative thing. If we take this group back out to a longer term picture, you know, they've made a really nice turn. And I think that you'll see these reestablish themselves. It looks like I've got a bit of a connection problem. Reestablish themselves over the next few weeks. So no, we continue to be bullish in this group.
That's great. Thank you so much, Dave. Well, we will continue to keep our eyes and ears abreast of any change and any major news announcement with respect to the presidential race and election. Thank you to all of our viewers for continuing to watch us every Wednesday afternoon. I think this webcast has been a great success. And if you have any questions, feel free to email myself or David, phastings@barometercapital.ca. And we'll see you all next Wednesday.
Yeah, Pam, as always, if there are changes that take place midweek that have a significant impact, we'll send out something to clients. But as it stands right now, I think we're in pretty good shape.
Of course. Thanks so much, David.
Thanks very much. Thanks, everybody.